Happy Thursday to everybody. It's a beautiful day, and I hope that you are doing all right. We still have some students. It's amazing. I haven't kept track exactly, but fewer and fewer students are ready at 8 o'clock than they were earlier in the semester. I don't know if that says something about me, probably, or maybe says something about, well, maybe any number of things. Anyway, I hope you're having a good week. Um, I know I am. We're just for those who are tuned in already, which is I hope less than half of who will eventually be here. But class will end just a touch early today. I have a doctor's appointment that couldn't be moved, so uh, I'm needing to trundle off to for a little bloodletting, uh, a little uh, close. Well, anyway, we're gonna have to in class just a little bit early today. But this is the start of a new topic, so we're I think we'll be fine. We'll be able to. This will be easy to catch up on. Okay, don't forget some brief announcements here. Uh, don't forget we have a midterm next Thursday. It will be again a midterm that you can take over an open window of maybe 24 hours. Maybe I don't know exactly how. Haven't determined that yet, but over an open window, so you don't have to take it at class time if you don't wish to. Um, but it will be time constrained, so you don't get 24 hours to take it. You get some other length of time, probably like 75 minutes, regular class time. But you can take it anytime in there. I think I made that clear. So, so you don't have to take it at class time. We will not have our regular class next Thursday. That will be for you to dedicate to taking the test. And in preparation for that test, since we're changing gears here, I know we talked about a little bit more material on Tuesday, but since we're changing gears here, the homework, any homework that we have this coming week will be light or none. I haven't yet determined that. There might be some. I might give you a few questions about what we did on Tuesday, but it'll be a light homework week. And and one other, I'll give you a kind of a heads up on something that we'll be doing in class that you'll need to turn in, but you don't need to turn that in before the test. I'd prefer that doesn't mean that you get to loaf for the next week coming up to the test. My intention here is to give you time to prepare for the test and to let you review your material and perhaps most importantly, generate any questions that you have, anything that you're not clear on, that you will then have plenty of time to ask those of Mitch and of me. It looked like the last homework quiz style went pretty well, all things considered. Not perfect on our end, and regretfully not perfect on your end, uh, but you I think you all are going to do well on the midterm in general, so that's good. Let me see what else. I also know that Monday's a career fair for you guys, so I would encourage. I know this is not your your father's career fair. This the virtual nature of these things uh, grows weary, and so. However, I would encourage you to participate to the extent you possibly can. This is a great opportunity to meet people and to learn more about the business you're going to go into. So please take advantage of it and head over to the career fair. Okay, finally, there are some files posted on Canvas for you for today. It's under, gosh, I don't know what it's under. It's in the files in class, and then it's got a folder with today's date on there. And there are 3 files posted there. There's a PDF file that has a few slides we're going to talk about today. Today's probably most of the time when I introduce we change gears and get into new material, there'll be some slides. So there are slides for today, and that's kind of today's focus. I don't like to do just PowerPoint stuff, but today's going to be more PowerPoint-ish than I wish. There's that. There's a spreadsheet and another PDF file, but it's got an income statement and a balance sheet on there, and then some questions. And it may be called in class. We're going to be talking about it in class. We may not get to that today, but we will be talking about that. And there are some questions in there that we'll answer some of those questions in class. And then I will ask you to complete that as a homework assignment, and we'll turn it in. But don't worry, it's not assigned yet. Nothing you have to turn in the short run here. So have no fear of that. Okay, I believe that's all for the announcements. Again, I feel like I need a producer to look at all the things I need to look at here. If you have questions, feel free to ask these as we march along. This gear switching is, when you have you have mental models of things that you build, and generally in a class like this, that takes students who you all are a very unique combination. I don't know if you've been told this before or not. You're a very unique combination of some base quantitative skills and some highly creative and design-oriented skills and desires to design and build and create things. And that means that some of this material on the economic and finance side doesn't come naturally. And as we've been through the first part of this, and you've kind of set a mindset on the material, now we're going to change it up on you, and you're going to have to change your view of it a little bit, because we're going to do some math, but we're only going to form ratios for a while. First we have to understand what an income statement and a balance sheet is and why you need it. We'll talk about that. But then we're going to develop performance measures by looking and examining that information that's presented in those 2 particular documents. We could talk about a lot of different financial documents, but these 2 in particular, the balance sheet and the income statement. We're going to try to understand those. We're going to analyze those so that we can tell if a business is doing well or doing poorly, and if there are problems, what might be the remedies. So the construction business in general is different than so many other industries, and you all are well aware perhaps of some of those things. But for example, you're unlike steel, where my son works, or Procter & Gamble, projects drive the construction industry. It's not like there aren't projects elsewhere, but most industries are more process oriented. Materials flowing through a system generating inputs, transforming those into outputs at either one location or multiple locations that are very similar. Process oriented. You all are project oriented. Construction is decentralized. Things happen at different places. They don't happen in one. A lot of things in one place. Of course, there is a lot of stuff going on in one place. And yes, it is a process. And yes, improvements come by moving from project oriented to process oriented. And you'll have classes where that's discussed. But the project orientation makes some of the performance measures and the performance measuring issues unique for you all. The cash flows are different. The payment terms are different generally in construction. The cash flows, you spend a bunch of money up front, and then you generate the value in that by which you construct, and then you're paid. Now that's, certainly in regular industry, in a normal process industry, they do a lot of investment up front. And there are processes, and they are paid when products are shipped. So in that sense, it's similar. But in construction, it has a different, it's a different model for how all that happens. You do use a lot of subcontractors. In typical process industries, there aren't a lot of subcontractors. And, so still, like all managers, all industries, all companies, you have to manage profits and costs and people. We don't talk about the people so much in here, but you have to manage cash flows. As I said 2 or 3 weeks ago, you can be bringing in a lot of cash, and you can still go out of business. Conversely, you can really struggle on cash flow and be doing very well otherwise. In this next set of classes, this may be 2 weeks worth, we will hopefully understand why that's true and how all this works. So chapter 1 is kind of an overview of the financial issues and a general statement about why construction is different and how construction looks from a financial perspective. And then in chapter 6, which is I'm going to jump right to chapter 6. Chapter 6 is where we start, the rubber meets the road. We start looking at a lot of these documents and statements and numbers and how all that works. So that's what we're going to do today. Is I'm going to, after I just time out here, just a second. After I have my coffee, we're going to dive into trying to understand, looking at the finances of a company. We're not decision making like we were with the engineering economic types of materials. We're now we're looking at data, and we're looking at current data, we're looking at past data, and then from a pro forma perspective, we're going to look at future data. And that's very important to try to understand where an organization is heading. And we'll look at those ratios to see how an organization is doing, and also to be able to compare those ratios, those measures of performance, with other companies in the industry. So every industry has certain ranges for a lot of these performance measures that are typical of organizations in that industrial sector. certainly construction is is no different, and so we'll look at some of those particular measures. This would be it, probably, maybe even after, or maybe next Tuesday. So let's dive in, and well, let me before I really dive in, let me share with you. This is just a short preview here. This is a let me show you these documents, and then we'll talk about them in detail. This says financial analysis in class assignment. We're not doing this today. Repeat. We're not doing this today, and we're not going to answer this today, I don't think. And we're not. This is not an assignment yet to be turned in, so don't panic. We will get to this. Okay, so a balance sheet. This is a balance sheet, and some of you, I think, maybe have taken accounting, and that's wonderful. Accountants are your friends. Accountants get into the nitty-gritty of these things. The accountants that I know are wonderful people. Seriously, I'm not blowing smoke here. Wonderful people, and generally they like what they do. I would find it awful. I would find being an accountant to be just horrendously boring. Now, so therefore, I'm not an accountant, and they find it exciting, and they are accountants, and they know where all the skeletons are hidden. They can look at the finances of an organization, of a company, and really drill down and tell you what's going on. So it's wonderful. Having a good quality accountant on your team is critically important to success. So I encourage you to. You probably know some accounting students, some friends, maybe even. Make sure you continue to know them, and maybe they can work with you sometime. Okay, a balance sheet is a snapshot. It's not a movie. It's not anything that it does cover a period of time, but it is a snapshot of an organization at a particular point in time. And for example, and this has the current year and last year, and I'm not going to get into detail here, but I just want to explain. This is all of these different accounts, and when you set up an organization and your accounting system, you will have a set of accounts, and everything will have a proper account to be charged to or to be pulled from. Sorry, I had to admit somebody else. So so in these accounts, this is all the values that appear in those accounts at a particular point in time. And we won't go into the details of what each one of them is, but you can see there are current assets, which are more active and moving, and fixed assets like buildings and equipment. You'll see things, words, terms in here that you may or may not be familiar with right now, like depreciation. We'll be talking a lot about depreciation later. Then, so you've divided these into assets and liabilities, and liabilities are current and long-term liabilities. And then we get into owner's equity, what the owners of the firm, whether that's an individual or a group of individuals or a set of stockholders or whatever that may be, their equity stake in the organization. And you can see, certain things most people know about balance sheets is that assets equal liabilities. So you look at total assets here, 1 million, and total liabilities, 1 million. So anyway, snapshot. And the next thing on this document that is posted again on Canvas is an income statement. And an income statement and is certainly also at a particular date. You build this income statement uh, at a particular time. However, it reflects things that occurred over time. So it's more like a movie in a sense that um, it's reflecting sales and revenues and costs over a period of time. Um, and so you've got all the costs, you've got the revenues. What revenue did you have over this stretch of time? And then you have all the costs that were incurred over that stretch of time. And typically in the construction world, we break that out into construction costs and equipment costs. And then you see what your gross profit is. And then you have overhead. We'll talk about overhead quite a bit. Overhead is a contentious and difficult. It's not a difficult concept so much as it's difficult to apply and to understand and to build. Then you have your net profit. You've got profit before taxes. You pay your taxes, and you have profit after taxes. So, and there are several terms that you can throw around, like earnings before interest and taxes. That would be maybe somewhere around here, and then there's that's EBIT, and then there's EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And there's all these different sorts of financial terms that we will discuss, and we'll throw around like we know what we're talking about. I'm putting myself in your camp here. A lot of these things, I'm quite familiar with them, but there's a lot of them that boggle my mind. And then there's a series of questions. Once again, we're not going to answer those right now. You'll answer them eventually, and we will answer them. And the good news is that for us, it's going to be rather cookbookish. Like write down the equation. There's an equation for this. You can write it down, and then you can calculate it from the numbers. But cookbookish and yet confusing at the same time. That's why you want to have a good accountant on your team. So now we have these statements, and you would prepare these statements annually. At least you would have an annual income statement, the end of your fiscal year, FISCIL, fiscal year, and that is your financial year. And you would have a balance sheet. You'd build a balance sheet. You may keep a balance sheet, actually. You want a snapshot at the end of each week, or you want a snapshot at the end of each month, or you want a snapshot at the end of each year. You could build your balance sheet accordingly. You could have, by the way, your own personal balance sheet. You have current assets. You may not have much. You might have a college couch, that you have in your apartment. You might have an automobile. It may be a junker, but it's an asset and it has some value. And so you've got current and fixed. You have cash in your pocket, maybe. You have a card, probably, but a card isn't cash. So that's detail we're not going to worry about. And you have liabilities, and you have accrued liabilities. You have rent that you've promised, right? That you're gonna pay, but you haven't paid yet, but it's committed. All those accounting things, and you may have some equity in yourself. And finally, so you have your own. You can build your own balance sheet for you, and you could build your own income statement. There may be, for many of us, it's it can be kind of blank, but you could do all those things on yourself, and you might think about that. That may help you to understand what's going on here. Okay, I'm gonna get away from that. You have that document, and you can look at that at your leisure. Um, I would like to now pull up the, it's a PDF file for you, the slides for today. And let's look at some of this information. So this is accounting and finance, and that's kind of a very broad, very broad statement. I have slides here that get into some really, really ugly accounting detail, and we're not going to cover all those. We're going to cover the ones that I've given you so far, but we're not going to cover in detail all the ones that I will ultimately provide for you. But it's important to see how the sausage is made here. In a sense, you don't have to be the sausage meister, but you need to understand enough that you know what your accountants are up to at a very high level. So we're going to talk about accounting and finance way up here for a while, and we will dive into detail where it's appropriate for us to do so. Okay, so I talked about this with the numbers, and now some outline detail here and where we get from one place to the other. So, these are intimately related, and we'll see a slide here next that talks about how the income statement and the balance sheet are related. So we have revenue and costs, and this is the general categories of the construction costs that we just saw in that other document. And we know that the gross profit down kind of at the bottom of your revenue and cost document is gross profit, which is the revenue that you have generated. Now there are different accounting methods that are generally accepted. There's a set of rules called GAAP, generally accepted accounting principles. And these principles that you have determine whether you want to account for things on a cash basis or what's called an accrual, ACCRUAL, accrual basis. And you need to, as a company, you need to decide how all this is going to work out and how you want to account. Generally, you got to be a pretty small outfit to account for things on a cash basis. It certainly is simple. It's not necessarily more easily manageable, but it is simple. But generally, you're not going to account for things that way. You also have to determine whether or not, well, you will have, when they talk about keeping two sets of books, sometimes in a movie, at least in the movies I watch, you get two sets of books, and it's like, oh my gosh, two sets of books, look out, this company, this shady stuff is going on. Well, not necessarily. Because you have the management of the organization, and then you have the reporting and the tax implications of the things that you do. So I'll talk about that in more detail here in just a short minute when I get down to the next items. But you may legitimately keep two sets of books or more so that you can effectively manage your organization. And And you'll see the implications of that, particularly when we hit an item down here in just a minute. So my point in all that, the revenue triggered that in my mind. That revenue is not necessarily cash flow. It depends on your accounting system and how all that is going to work. So let's not, I guess maybe not get mired into that right now. All the money coming into the company, however we account for it, is going to be revenue. Then we have our costs, and then we have gross profit, which is revenue minus those costs, minus the construction costs, minus the equipment costs, and we get something that we would call gross profit. Now, you know the term gross profit, so that means we're going to do some other things with it. That's kind of a high level sort of profit that we're going to do more things with, if you will. Okay, then we have overhead. And overhead consists of those things that you cannot directly bill to a particular project. Now you can bill overhead elements to particular projects, but things that cover more than a project. For example, at the university, there is a large organization called the Office of Sponsored Programs. Well, at least that's what it used to be called. I don't pay attention anymore, so I don't know. But this Office of Sponsored Programs helped researchers. It built contracts and helped with proposals and managed funding as it came in, accounts for funding and making it available to faculty and staff, all that sort of stuff. Well, they would qualify as overhead because they served a whole lot of different people, a whole lot of different projects, and they were available for projects that didn't go, that wouldn't be charged. So they would qualify as this overhead. Human resources is often included as an overhead element. Everybody needs it, you got to have it, but it's not part of constructing an edifice, right? You're not using it to build a house. It's a help for building a house or building a mall or building an office building or a high rise. So those fall into the overhead category, and determining what is overhead and what isn't overhead can be a challenge, and there's some maybe back and forth for what all that is, but you'll notice that typically it's quite high. I don't know what the overhead rate is. Usually you take the total cost of something, and the overhead is then applied as a percentage of that cost. I don't know what the overhead rate, what that percentage that's added on is at tech anymore. It used to be in the mid 50%. So 53, 55% was the overhead rate. I would venture that it's reasonably higher now. Some consulting firms, design and engineering firms, may have overhead rates as much as 100 or 150%. So you'll see it when it pops up, and we saw it briefly on that last document we looked at. So you have gross profit, then you have your overhead, which generally is quite a bit of money, and that gets you your net profit from operations. So and the operations part is, okay, this is doing what we do. Those are operations. Building what we build, not with the other income and other expenses unrelated to doing what we do. So that's net profit. Then we have other income and expenses, and we have that could be any manner of things, and we're not going to get into that in much detail. But that gets us profit before taxes. And then, of course, we have to pay our income tax. and then we get profit after tax. And of course, it's this, the profit after tax, there's your bottom line right there. Earnings before interest and taxes. Interest is accounted for in a little different way. You can, anyway. Up here is also kind of a bottom line, but this is the bottom line, the profit after tax. And you want to the extent you can, you want to look at these things after taxes. Now, this is where I wanted to look at this equipment cost category over here, and in about 3 or 4 weeks, maybe we're gonna talk in detail about this concept of depreciation, and it is, when you I said I thought accounting was tough in terms of keeping my interest. Depreciation is kind of the tough of accounting. So we'll slog through that thing, but it's really critical. And depreciation is the decrease in value of an asset over time. And so you understand that if you own a vehicle, that if you wanted to sell it today, you couldn't sell it for what you bought it for, unless you're a collector of fine classic cars. It's worth less than it was before because you've driven it. It has more miles on it. The tires are more worn, etc. So equipment in the construction industry is the same. You suffer from the same stuff. As soon as you buy a beautiful new piece of equipment, its value has already decreased, and it will continue to depreciate as you use it. The good thing about equipment is you're using it to produce income, right? It is an income producing asset. So you have to account for, if its value is less, for example, your assets are less because it has reduced in value from one year to the next. And depreciation is the way you reflect that, and you reflect it as a cost. That amount of depreciation that you assign to that piece of equipment reduces your assets and is attributed as a cost to you for that period of time. Now, back to the tax issue. The government, in their wisdom, and I mean that, I'm not being snarky or sarcastic here, in their wisdom, provide you with tax breaks for depreciation. And so as you depreciate, the government will tell you how much you can depreciate. And typically, you can get government depreciation greater than what the actual stuff is. And what that does is, for tax purposes, your costs are greater, your depreciation is greater, typically with the government depreciation schedule. So you follow that schedule to calculate your taxes, because the more a penny saved is a penny earned, right? The more you spend, the more you save. I don't know where that came from. Don't quote me on that one. The greater your costs, if your costs are greater, your profit is less. Your profit is less, your taxes are reduced. So you love to increase your cost as long as it doesn't cost you anything. Now, that seems counterintuitive until you realize that depreciation, remember, it's not really a cost. I mean, it's not a cash cost. It's not cash you're paying. It's just a reduction in value of your asset as you use it. So it's a non-cash cost, and that's actually a good thing, because it reduces your tax burden. And the government gives you this big depreciation, and you want it, you take it, it's a wonderful thing, and you will account for it according to the government's rules. However, for managing your business, that you may not want to, you may not think that much depreciation is really appropriate from a management perspective, from managing your assets. So in your other set of books, you may have your depreciation at a different level to reflect what you believe is the true reduction in value of that asset. And so this other set of books you may see as an accurate representation of the value of your firm. And the other one you do for tax purposes, and those are your official tax purpose government certified books, right, that you use for that. So that's kind of a rabbit trail, but many of these things you will need to leave to your accountants. You need to understand kind of how it works, but you need to leave it to your accountants to make most of these decisions like that. We'll talk in detail about depreciation when we get there. It's chapter 5. It's coming in a couple of weeks, I think. Okay, how about the relationship between this income statement here and a balance sheet? Because while one is truly a snapshot and one reflects changes over time, they really are intimately related. And it's so the and you don't need to memorize or completely understand this at this time. Eventually we'll get there. Okay, so in the balance sheet, we know that assets are equal to liabilities plus owner's equity, right? That's almost the definition of a balance sheet, right? Your assets and your liabilities have to balance. They have to be the same. Also, we can say that the revenues, we could change the profit equation so that we solve for revenue. Revenue upfront is equal to all your expenses plus the profit that you have. And then the balance sheet and the income statement together reflect the change in equity, and that's equal to the profit. So the change in the bottom part of that balance sheet on the liability side, the equity, is your profit. So just kind of a peek here. Here's the balance sheet. Here is at the end of year 2014. I don't think that's 1914. We could pretend it is. And here's the balance sheet snapshot, right? Snapshot at the end of 14, snapshot at the end of 15, the following year. So we have cash, for example, and that's $80,000 in our pocket at the end of 14, and that goes into what's called a cash flow statement. We didn't look at a cash flow statement, but you can see that there's cash from the operating account. There's also an inventory account and a financial account, and so there's a net increase in cash. And what you started with, you get an ending cash, and that ending cash shows up on your balance sheet the following year. You increased cash, your cash holdings by $30,000. Also, so down here we've got retained earnings. So we have 760 retained earnings at the end of 14. Well, from our income statement over the process of the year of the year 2015, we had revenues less all of our expenses, and our net income was $864,000, and that shows up down here in the statement of retained earnings. We did not look at a statement of retained earnings, but they just kind of shows you in all of these statements. There are other statements, so we're not necessarily going to get into to derive some of these numbers that go into the income statement, for example. And we plug in. We had the retained earnings, and that's got a typo in there. This should be from 12/31/14, not 12/31/10. My apologies. And we have our net income for all of our operations during 2015, and we may take out dividends. Dividends are profits that are divided among the shareholders and distributed. So let's say, for example, this is $400,000. Let's say, I'm making this up. This isn't on the sheet anywhere. I'm just making it up. That this is this organization is a partnership, and a partnership of 4 individuals, and they're all equal. I don't think you'd have it this. You probably would struggle with this. But if you had a partnership with 4 equal partners, owners, these are the owners of the business, and you had dividends of $400,000. What that would mean is you would divide that 4 ways, and each of the partners would get $100,000. That's their dividend for their stock ownership. And anyway, that reduces, it's in parentheses, that means it reduces, right? It's a negative, reduces the retained earnings, because those would be retained in the company, but you've distributed them as dividends, so they're no longer in the company. And you take what you had before, what you added, subtract the dividends, and you get your new retained earnings. And again, a typo, must have had different years here before. The typo here is that this should be 12/31/15, and that number would go into the retained earnings of the balance sheet, then that snapshot at the end of 15. So there are numbers that come out of this. You have a balance sheet, see, for you, balance sheet here, right? And then stuff happens, and you have your income statement, and you've got profits and losses and generating revenues and costs and all that stuff. And then you look at the picture here, the balance sheet at the end of 2015. So certainly you can imagine that what you started with, the snapshot, has been changed by all these things that went on in between. And those numbers go into the calculations. They reflect the changes from one year to the next. So there you go. That's the 30,000 foot view of this. We're just so you know, just interjecting here, we're not taking a break, only because we're gonna end a little bit early. So just gonna plug along here. Looks like I'm not going to get through the slides I gave you this time, but some of them you can look at that you don't need me to be jabbering away for some of these. Okay, now here's where the fun begins, and that is your accountant has performed due diligence and done all of this work, and it's been well done, and it's accurate, and it truly reflects what's going on in your organization. Now, what do you do with that information? Gathering it, generating it, having it for the government, for calculating your taxes, for audits, external audits that might occur. It's very important to have the information, but you want to use it to manage your organization. All of this, like I said before, not today, but earlier class, as much as we, technical folks whether engineers or building constructors, much to our chagrin, when the world doesn't revolve, the world kind of revolves around the good work that we do, in one sense. But the good work we do gets lost if you're not financially secure and solvent and profitable, and your business is a growing and continuing concern. And all of that is financial things. And so when we manage, while we'd like to manage purely technically, we have to manage primarily financially to make sure we're going to stay in business. So we take the numbers. Those numbers are the what's big today in data science, right? So we kind of have to do our data science on all of the information, the financial information that we have on the organization. So we look at some of these measures, and these measures are tried and true. They have been used over and over again. Every once in a while, a new measure will pop up, and if it's useful and helpful, it sticks around, and if it's not, it goes away. So we're not gonna invent any new ones. We're going to look at those that are typically and traditionally available and are calculated in the construction industry with respect to financial statements. And some of these are, they're applicable in other industries as well. There will be some that might be more important to constructors. So here we have 4 different types of ratios. And these ratios, there's going to be a set of ratios for each type. And these ratios indicate or cover particular, they're clumped together for particular reasons, in that they indicate particular, together, they indicate particular conditions of the organization. For example, activity ratios. And effectiveness was just too long, and I should have self-hyphenated, but I didn't. Effectiveness in putting the assets, in properly investing the assets. Okay, so you have assets. Your organization has a bunch of assets. Are you putting those to productive work or not? Or are they not productively used, effectively used? Well, activity ratios are those things that help to indicate. They don't tell you the complete story, but they help to tell the story and indicate if you're actually using your assets productively. Liquidity ratios. You remember a week ago, maybe week and a half, we talked about the payback period. And the payback period wasn't the present worth. It was, how quickly do I get my money back? How many years, how many months, whatever it is, how quickly do I get my money back? And I thought of a good example. This may help you, since there's probably gonna be a payback question on the midterm. This probably won't help you at all. I thought of a good analogy, and that is, if you play Monopoly, if you've ever played Monopoly in your life, you have some money, and you land on Pennsylvania Avenue, and that's pretty expensive property. And you need to know, gosh, I want to invest my money here, but I need my money back because I need to invest in some other properties. So I need to get it back quickly, right? You want to get your money back quickly in Monopoly so you can buy other properties. You don't want to overspend and then not have enough money when you land on Park Place or Boardwalk, right? You want to make sure you have enough cash for that. So you want your cash back quickly so you can be ready. That's payback? I don't know. Anyway, look, that's a liquidity ratio. Can you meet your short-term obligations, the things you need money for right now? And liquidity is having a cash position where when something comes up, you have an obligation now or soon, you can handle it. You can pay it. Uh, it's like having enough money in your pocket that when you go to Subway, you can pay for your sandwich as opposed to getting out your credit card, right? Even though credit cards are pretty liquid. That's maybe not a good example, but it's a kind of a minor example. You want to make sure you have enough cash on hand. Solvency ratio. These are biggies. This is staying in business. This is remaining solvent as a business. It's not a solvent like you cleaning your desk. It's being able to stay in business. It's, can you meet your debt obligations? Because if you don't meet your debt obligations, you know what that means? That means bankruptcy, right? When you can't pay your debts, you file for bankruptcy. But that doesn't necessarily mean you're going out of business, but it means your business is not your own for a while. But you have to be able to satisfy those. Those are solvency ratios. And then there's profitability ratios. And the profitability ratios are you're managing your income and expenses, and you want profits. That's the bottom line, kind of managing your profits. So there, again, these ratios, 4 different categories of ratios, and each category, there are several ratios in each, and each category then tells a story from the numbers, from the data, about the condition of the organization. You might think of this if you're a physician, right? And you're probably not, or you wouldn't be in this class. I'm not. Gonna go see one. These would be like different. Okay, let's do a blood test. Okay, let's call that a liquidity ratio. So we get a blood test. We measure a bunch of things. We see how you're doing. Oh, let's take X-rays. That might be solvency. X-rays or MRI or CAT scan or all that sort of stuff. We got a different set. They tell us different things. So this is a little bit like a diagnosis of the condition of the patient, using these different ratios, and based on the patient's situation, current situation, you might focus in on particular tests, and that's what these are, and that's what the rest of these slides cover as well. For example, if we look at the next slide, here's activity ratios. And these slides, I think, I'll breeze through them perhaps next Tuesday, but these are very self-explanatory, and I think you can get these, and they're discussed in the text as well. We have turnover. Okay, so these activity ratios, we have different types of turnover. There's inventory turnover. And this is certainly more applicable, inventory, in process industries than it is in the construction industry. And yet you do have inventory. Receivables turnover is a financial kind of turnover, and that is the total revenue that you receive divided by the average receivables. Receivables are those things that people owe you. So I'll let you look at these. Notice that the denominator in each case is an average. So an average isn't perfect. An average is not a perfect representation of a situation, but it's one that's useful. As I've said before, George E.P. Box, all models are wrong, some are useful. All these aren't perfect, but they're very useful in looking at a particular situation. So these are activity ratios, and typically they're turnover. Notice the second bullet up here. Turnover is a gauge of the efficiency of putting assets to work. For example, you want inventory turnover. You want this number to be very high. Chug, 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 chug. You want things moving. You want them moving and shaking, right? And so if it's moving and shaking, your average inventory is going to be low. And if the denominator is low, then the ratio is going to be higher. And that's what we're looking for. You want all of these things. Average receivables, you want that thing to be low, right? Because you want your money quick. Let's get my money back here. Now that would be a liquidity measure, getting cash back. But this is your receivables turnover is also it's not a liquidity measure, but it's liquidity related, right? So anyway, these are all activity ratios. There's also our liquidity ratios. And again, this is, can we satisfy the cash needs, the short-term obligations that we've committed to? Can we manage those? Can we handle those? And so notice that it says using assets that can most readily be converted into cash. So it doesn't have to be cash in your pocket, but it's those things that you can readily convert to cash. For example, if you have it's listed here short-term investments, you may have investments in personally, for example, in stocks. Well, you could sell those stocks, right? It'd take you a couple of days for the stocks to sell and you to get your money. Pardon me. But you could do that. It's almost like cash. There are short-term investments in organizations as well, right? All kinds of different things that an organization would be able to convert to cash quickly. So these get I guess I was going to say shorter or longer, but that's not necessarily true. So the current ratio is can you satisfy current liabilities using what you already have, your current assets. The quick ratio is can I do it a little quicker, right? That is, this doesn't include all of my assets, right? The denominator or the numerator here is not all of your assets. It's just those that you can get to quickly, kind of get them quickly. Take a while, maybe a couple of days, but it's quicker. The cash ratio, I can do it today. I've got my hands on this. Actually, with short-term investments, it may take me 2 days, but I can make it happen very, very, not just quick where I'm depending on receivables, but super quick, cash quick. So these numbers, obviously the current ratio is going to be larger than the quick ratio, and that's larger than the cash ratio. So that's liquidity. Can I make that happen quickly? Solvency is, I'm going to end here and we're going to bail. Solvency is, critically important, obviously. And I do know, I wish that I had some ready numbers to share with you during this COVID-19 pandemic. The number of, I know that this will be published at some point soon. The number of companies, not necessarily construction companies here, I think in general construction companies are doing okay. Companies that are looking at, their solvency numbers are dwindling because they're not allowed, they can't run their business. Small business owners are struggling. And most of the jobs provided are small business kind of jobs. So that's hurt employment tremendously. People are suffering from the economy not being open. And this is the danger sign down here. This is critical. This is really critical. And notice the different sorts of risk here. There is business risk and there's financial risk. You've got, there's risk everywhere. It's like, as we used to say, I'm going to say it, it's like a communist. There's one behind every bush, and there's risks everywhere. So we're going to, on the solvency, we're going to come back to the other ratios, and we're going to get into more detail. We'll look at the ratios for solvency and others, and start doing some of these ratios next Tuesday. We'll look at that document that we have, that other document that's got the income statement and the balance sheet, and we're going to start forming some of these ratios just for practice, so that we know how to do it. And then we're going to look at some comparative numbers so that we know, if we're in good shape or not. So I'm sorry that my lack of planning requires class to end early today. I hope that you all have a wonderful weekend, and start preparing for the midterm. I will post over the weekend a little bit of a guide. Guide is too strong a word. I'll put up some ideas about what you should expect on the midterm, and I'll also determine exactly how we're gonna make that work, so you can do your own planning and scheduling for next week. Okay, no questions. Looks like we're good to go. I've got to run. I'll see you next Tuesday morning. Have a great weekend.